Archana, for the introduction and good morning all. So before starting the webinar, just a quick standard disclosure that whatever the themes or ideas that we'll be discussing today, that will be just for the educational purpose, and do your own research or consult your financial advisor before investing. So coming to the this webinar topic, like navigating market volatility. So it has been quite a turbulent past 1.5 months for the investors. And we have been receiving a lot of query about from the investors on the market. So we thought let's take this opportunity and address the concerns around the market and where we are heading. And if there are any themes where investors want to put money. So let's explore some ideas where which looks good even in this market carnage and correction. So moving on, there are a few key risk event which has triggered the market fall in the last 4 or 5 odd months, right? And that has all started in October last year when there was incessant selling by the FIIs. And till now, they have sold close to 2 lakh crore or $25 billion of Indian assets, right? Indian equity assets. And that was mainly triggered by the weakening of the currency. And then and in the beginning, it was the weaker earnings prospect for the Indian markets, right? And then very recently, when Donald Trump takes office, so there was again widespread outflow from the emerging markets, including India, which has led to the intensifying of the selling from the FII side. So that was the first lever of the fall in the market. Then after that, in the past 1.5 years, what we have seen is that there was a lot of leverage position which was built in the market, and that leverage was kind of unwinding in the past 2 or 3 odd months, and we have the data to also showcase, but that has also had its own impact on the market, right? And these leverage positions has also kind of resulted in some bit of adding to the fall in the current markets, right? And the third was the rebalancing by the DII. So the DIIs, mainly the insurance guys, or mainly the mutual fund MC companies. So they run their they have launched a lot of thematic funds in the last 1.5 odd years, and also there was kind of overexposure going toward the mid side. So that stands to correct now, and there is kind of reshuffling that's also going in the mid cap, the mutual fund domain, which has led to the final the fall in the markets, and has also resulted in some bit of selling from the DIA side. And lastly, and the valuations and the earnings were always a kind of concern for the last 3 or 4 odd months. And we have seen muted earnings for the first 2 quarters, and also kind of valuations were kind of expensive, 40 to 60% from the large caps. But till the last year, it was kind of justified because of the higher growth that the market is seeing. Now that suddenly for the 2 quarters, the growth is not coming. So the exposure, the over valuations from the mid and small cap side is also has become a reason for the market to correct, right? So these were some 3, 4, 5 factors which has led to the market fall. But let's just move ahead and see what has done has already been done now, and from where we can chart our trajectory, and what all sort of things we can look to do going forward. So first of all, decoding the FII outflows. So what we have seen, the current selling which has been happening in the market, it's very unique in its nature, right? So first of all, we have never seen FIIs to sell their 0.5% of the Indian market cap, or roughly 2 to 3% of their Indian exposure in just in a matter of 3, 4 odd months. So they have done it in the past, maybe during the time of global financial crisis, or maybe a black swan event like COVID. But bearing that, we have not seen that just because of the concern of valuations and the earnings slowdown, they have seen they're exiting their Indian holdings in such a hurry. So it has happened during the global financial crisis. It has happened during the COVID. But apart from that, whenever there is a concern around the valuation and earnings, it has always been limited to 0.5% of the Indian market cap. So, for example, here we can see that during the April 15 to February 16, when there was a banking asset call cleanup being done by the RBI. So that time also the FIIs have sold net in around 0.5% of the Indian market cap, or 2.5% of their holdings. And very recently, around 18 or 19, when the mid and small cap rally was at its peak. So that has also the time when the NBFC crisis happened, and that was again a trigger for the FIIs to sell around 2% of their holdings. So currently, we are not seeing any sort of corruption, or any sort of regulatory, or any sort of the governance issue from the domestic companies. It's just that pure simple valuations and the earnings mismatch which is happening which is happening and which is putting the FII outflow from the Indian markets. But again, one of the main reason was that the currency that has weakened in the last 3-4 odd months. So that has impacted a lot, and it has turned their last 3 year returns negative from the Indian market, and that's again one of the reasons why they have sold. But what we have seen that when it reaches a number of 0.5% or that 2% of the overall holding, so it generally stops if it's not a black swan event like GFC and post-COVID. So whatever the selling that we have seen the most of it, and hopefully going forward, the pace or the pace of selling should kind of moderate from here on, and we'll be seeing some bit of FII money to come back again on the emerging markets going forward. But till that time, the Trump this tariff situation is going on maybe for the next 2-3 months, and it's not getting sorted out. So we'll see some bit of more selling going forward from here. Now, the other point was some systemic leverage that we have been seeing. So slowly over the time in the last 1.5 odd years, we have seen that a lot of new investors have come into the market, and in the search of making quick money, they have taken leverage positions, and that position has rose sharply from 66,000 crore to 82,000 crore in the first 6 months of the last year. But after that, we have seen some bit of cleaning, especially in the last 1.5 odd months, where the open positions from the NSE has come down from 82,000 crore to 66,000 crore. So that has it has been quite a lot of liquidation of the domestic money which we have seen happening, and the open positions coming down. So again, it shows that the growth which was there in the system, for sure, it has been cleaned up by some bit, and the kind of leverage position that we are seeing right now, so it can come down further from here on. But again, what was the worst of it was, it's already behind us now, and maybe we can see some bit of consolidation and cooling from here on the unwinding of the leverage positions. Now let's look at what history teaches us in terms of the previous falls. So in the history, we have seen some 4-5 fall in the market, and very recent was the January 22 to June 22 fall that's mainly got triggered by the Russia Ukraine war, and in that also we have seen the carnage in the wider market. So currently the Nifty has fallen around 14, 15, 13, 14%, but the main carnage has been done in the mid and small cap space, where the small cap is already now in the bear trajectory, falling 22% as on yesterday closing. So we have just looked at the events where the small cap index has corrected more than 20%, and the very recent occurrence was in January 22 to June 22 time period, when the index has fallen around 27%. And it took the entire consolidation of the market was for 1.5 odd years. And on the way to recovery, the index has given up. The index has made around 37%. But after that, the rally that we have seen, so it was quite a bit rally that we have seen, with the index going up by almost 90%, including the current fall, right? So the corrections are part and parcel of the game. Sometimes it gets triggered by some outside events like maybe GFC or COVID, or let's say some banking crisis. But a few sometimes also get triggered by the excessive valuations and the current kind of correction that we are seeing in the market. So it's just because the correction that we are seeing and the kind of valuation that the market was, the correction in the earning that we are seeing and the kind of valuation the market was at earlier. So mainly because of these two factors we can attribute to it. And since that the valuations are already corrected now, right, 22% from the small and mid cap side, and we have some sort of commentary coming in from the management from the Q3 earnings, and also the kind of hope which is there for the quarter for the next year. So we see that whatever the worst that has happened to the market, that has already happened. One important thing to keep note of the correction here is that whenever it triggers and goes down below 20%, so it falls some more, right? So maybe the index can go down to 26-27% level again, and before consolidating, and before consolidating in the zone and waiting for the market earnings to recover, and then from there we can see some bit of recovery on the broader market side. But whenever the recovery happens, so we have seen the index to participate in a very good manner. So for example, in the last correction that we have seen in the March 20, the index for the mid and small caps have corrected roughly around 47 to 56%. But after that, the 3-year return was roughly around 146% to 206%. So whatever the correction that we have seen in the past, roughly 3x to 4x return has been made in the next leg of the bull cycle. So somebody who is who has some dry powder ready, or who are sitting on cash, or have some bit of more liquidity coming in, So ideally, now is a good time to put back the money if there is an investment horizon of 3 or more years for the investor. Now, again, one of the things that has happened in the small and mid caps over the past 6, 7 years is that the companies are governed in a better manner now and they are more operationally efficient. For example, in the period between FY 17 to 20 CAGR, the free cash flow for the small cap 250 index was roughly minus 16%. That was the time when the correction of correction from the small cap index has happened, and then there was a lot of NBFC crisis which was there around at that time. So the companies were poorly run, but the companies were just running because of some news announcement, and the valuations were quite sky high on the back of weaker earnings. But post at what we have seen post COVID, the companies have actually recovered, have become efficient in managing their cash flow, and their free cash flow generation has actually been around 51%. And if we extrapolate it to 25, so that's roughly around 35-40% CAGR that we have seen in the past 4-5 years. In fact, earlier the companies were quite leveraged between 17 to 19, roughly 1.4x to 1.3x, but now that has virtually the companies have become debt free, and that has again led to the reason why the companies are managing their earnings even in the rate environment of the last 2.5 odd years. Lastly, the revenue CAGR that we have seen for the small cap 250 is roughly around 16%. The earnings CAGR is roughly around 18% in the last 4-5 years, but the capex has been done only at the range of 9%. So what we see going forward is that the companies are now sitting on QIP flows, we are sitting on the free cash flows, and going forward, if there is an opportunity, so the companies are actually announcing the capex and the projects to actually increase the future revenues. So there could be a cyclical slowdown in the economy, not a structural one, maybe for 2, 3, 4 quarters, mainly because the government has withheld the expenditure, and also there was some bit of fiscal tightening in the economy. But once the government has corrected its course, and also the RBI has corrected its course, and now we are seeing the liquidity finally coming to the market, so we can see that capex announcement to also grow going forward. So what we believe is that it could be a very near-term pain of, let's say, 1 or 2 quarters, and from there on we can see the increased revenue from the companies and finally adding to the bottom line to add to the small cap valuations and the future return profile. Lastly, the concern around the valuations. So what we have seen is that bearing midcap 150, if we take the last 5-year median P of any of the index, the current P as on 10th of Feb, right, it has gone down quite significantly, maybe in the range of 15 to 25% depending on the index, especially for the small cap 250, which was earlier trading at a forward earnings of 26x. Now it has come down significantly to 22x, right? So a small cap company, small cap index trading at a 22x with a forward earnings guidance of cumulative earnings expectation of 18 to 19% looks kind of reasonable, right? So it brings it down a peg of 1.2 to 1.3, which is kind of reasonable for the small cap universe. And we see that there is a lot of value now in a large number of pockets into the market. Now, again, just to have a look into how the markets have behaved, especially the small cap index has behaved in the past. So if we study the last 20 years of data, what we have seen is the average decline from the peak for the index was roughly 45%. Average gains that we have made from the bottom is roughly 20%. And the upcycle range is roughly between 24 to 32 months. It means roughly 2 to 2.5 years a cycle lasts. The current cycle, which is started in June of 2022. So in the current cycle, we have made only 90% return. So for those who feel that there is a froth, there is a valuation in the market, it was there around 2.5 months back. Now the valuation stands corrected. In fact, the kind of return that also an investor has made, it's very muted, CAGR growth of 20 to 25% in the domain. So as such, no growth we see. It was just a concern on the growth and the valuation part, which we expect to correct, do a course correction in the next 2 to 3 quarters. In fact, if you look at the 3-year CAGR of the price performance and the earnings growth, so the price performance is roughly around 17% for the small cap 250, while the earnings growth has been around 18%. So obviously the earnings has been superseding the price performance growth, and the valuations, that's why the valuation tends to correct from the 5-year median P that we have seen. Now, having discussed all those factors, so let's come to the final question: that has market bottom out? Is it the right time to put money again into the markets? So let's examine first some 3-4 factors. which can go in investors' way going forward. So first of all, the correction was mainly got triggered by the tight fiscal and the monetary policy, and both the RBI and government has recognized that, and we have seen the loosening on both the front. So first, government has done a income tax cut for the salaried guys, and we have seen the liquidity of 1 lakh crore coming to the market, which has a multiplier effect of 4 lakh crore. But that will not happen today. That will be happening over the next 4 or 5 quarters. So that's again one, it will be a boost to the consumption. The other part to it is the monetary policy loosening, right? So we have seen for the first time that RBI has done a rate cut in the last 4 or 5 odd years. So this rate cut of 25 basis point will not add any material value today, but it signals in which direction the RBI is thinking. And in fact, we have seen a lot of bond buying and liquidity injection by the RBI also into the system. So which gives some bit of boost to the consumption, which has been taken a break in the past 3 4 odd years. Now the other concern was the GDP growth rate concern. So mainly in the past quarter we have seen the GDP growth rate to be slowed down to 5.4%. So we expect, in fact, the RBI has also highlighted that the growth is kind of cyclical, and it was on the back of it withholding the government capex. So going forward, we can see the GDP growth rate to be back on the target line, which is like roughly 6.5% to 6.7%, heading to a 10% of nominal growth rate for the next 2 3 odd years. So if the index is growing at a rate of the economy is growing at a rate of 10 11 odd percent, then we can see the earnings to compound at a rate of 14 to 15%, which is similar to the past earnings that we have seen in the past 3 4 odd years. Now coming to the global trade policy, so we have seen a lot of uncertainty around it, and which was also the main trigger point for the FIIs to pull out money from the emerging market. But since US is imposing tariff not to increase the inflation in their economy, but as a negotiating tool, and we have seen that the trade policies being relaxed and being kind of moderated upon further discussion. So we see that this is just an uncertainty period for next 2 3 odd months. And once the Trump government will complete its 100 days into the office, and we'll have much clear picture where the US economy is going, and what shape it's taking going forward. So we can also investors can also decide about the course for the domestic market, and it will not have much bearing. In fact, the kind of trade impose the tariff impose which was there in the India. So we just export 5% of our exports to the US, right? So we kind of it's kind of limited in terms of the exposure that we have because of the tariffs, but it's because it has a lot of sentiment effect also, right? So because of that, a lot of money is being pulled out from the emerging market. So India can't be signaled out, and again there is a FI outflow from the India as well. But we hope that in the next 2 3 months we'll see the worst of it behind us, and we'll see some bit of inflow coming back as well going forward. Now the last final 2 point is the valuations and the earnings. So where we stand today, the valuation stands corrected at around 25%, and that gives a lot of room and comfort for an investor coming to the market today, right? And clearly there are companies which are still growing at a rate of 20 25 odd percent in the current market, but it's just that we are going through a capitulation phase, and the holdings are being liquidated by mutual funds, liquidated by financiaries, right? Like they are liquidating the leverage positions and again being selling by done by the FIIs. So we see the sentiment at the absolute rock bottom, and this is the time to put money into the market if you can withstand some further 4 5 correction to the market, 4 5% correction to the market. And then next 3 to 4 years could be a good time to make decent returns for the investor point of view. Again, earnings are expected to make a comeback just because FY25 was a very bad year, so we have a favorable base in our side. And whatever the government capex is doing, the loose monetary and fiscal policy, that will again add back to the GDP, and we'll see some higher earnings coming into the FY26. So whatever the concern was there that earnings will slow down, that will alienate, and we'll again finally see the investors flocking to the market. So that's our view on the market, that if a new investor is coming to the market, he should ideally stagger the investment over the next 2 to 3 quarters. And also, if somebody has some liquidity in place, so they can look to do a top up currently, and we are doing the same approach. We are making the portfolio defensive, so that the further capitulation we can withstand some volatility into the portfolios. So with this, I would like to conclude my part, and Vijay will take care of the next part, which is mainly the themes that can look to outperform in the current market. So over to you, Vijay, now. Thank you.
Thank you, Prabhat. So we can move to the next slide. Yeah. So in this section, we will basically spend time on the quality and growth investing. So my colleague Prabhat has already covered the recent landscape, what is happening. Now the question comes into, let's say the valuation stands corrected. So which is the place or which is the theme or which is the style that we should focus from, let's say, next 4 to 5 year perspective. But before that, we would like to spend a couple of minutes on that what is the main key driver for the stock price returns in long terms. So we have done a basic analysis. So what we have done is like we have um, um, captured the last 10 years market cap CAGR, basically the price CAGR for the index. And if you look at the BSE 500, it has generated around 19% CAGR for starting from FY14 to FY24. And if we divide, let's say if we break down the CAGR earnings, like how much it has happened from the valuation expansion or how much it has happened from the earnings growth. We typically see 12% earnings, 12% price CAGR is attributed to earnings and 7% is attributed to the valuation re-rating. But if we look at the companies who have done, let's say, compounding north of 20% earnings growth in the last 10 years, so there are 23% of the companies who have done this kind of compounding over the 20% earnings growth, and their market cap CAGR is around 25 plus 6, which is 31%, which is the rightmost candle. And out of that 31%, 25% is due to the earnings expansion, and only 6% is due to the multiple expansion, which is attributed to valuation. So in a nutshell, what we have seen, the companies which are high quality and they are able to generate excess returns in terms of earnings growth, let's say north of 20%, above the industry average. So they will compound at the healthy rate, and the only key driver in the long run will be the only earnings growth, not the valuation. Because if we look at the 30% CAGR which has happened, so only 20% of that, which is 6% around, is attributed to the valuation expansion. But majorly 75 to 80% is attributed to earnings part. So then in nutshell, anyone who wants to invest in stock market or let's say to play to the this wealth creation journey should focus only on the high quality growth companies, which will increase the probability of generating excess returns over the benchmark. So now we'll move on to the discussion like which is the style that we should look at in the next 4 to 5 year perspective. Yeah. So in this analysis, what we have done, like there are a lot of discussions happening around growth or value, which cycle will play out or which was the cycle that was in current flavor and which will be the again in the next 4 to 5 year perspective. Let's say once there is new cycle emerging. So where the money will flow or which cycle, which theme or which factor will come into the play. So what we did was we basically did some analysis on the, let's say, the equivalent index, and we mapped out the high P versus low P stocks, and we created the ratio. So in this chart, what it captures is basically the relative allocation between growth and value factor. So whenever this factor, let's say this ratio, which moves into the cyclical manner, whenever it touches the bottom part of the bottom range, so typically it is time to move into the quality, and whenever it touches the upper range, so it's a move to get back to the value cycle. So if we look at the April 20 on the right side, where we have mentioned like the it has already peaked out that ratio. So that was the time to get into the value cycle, and that was a time to go underweight on the growth side. And if we see from April 20, there was some outperformance on the value side, but later on, due to Ukraine and Russia war, there was pause, momentarily pause. And from September 22, this thing accelerated when the PSU stocks got under like heavy re-rating, and it ended up outperforming the growth factor in the long term, like in the last 1.5 year. But if we took a look at the in the recent the last 2 quarters back, this ratio has bottomed out to around 15-year low of 0.5, which has happened in the November 8, November 10, April 17, October 17, February 18 in the past 14-15 years. So this ratio is again back to the 15-year low. And in our opinion, whenever this the ratio bottoms out, we will see the disproportionate allocation happening to the quality and growth stocks, and they will tend to outperform the their counterpart, which is the value thing. value theme. So this is how we are looking at the market. In our humble opinion, we believe that it's a time to put money to the high quality growth companies versus the value play. And one more catalyst, like this thing will be going on, is the basically the cost of equity, which plays very high role when it comes to the valuation of the high quality companies, because typically high quality growth companies will have like very high terminal value because of their longevity of growth. And what we have seen, like cost of equity plays very important role when it comes to the valuation of the particular business. So what we did was we basically tried to capture the, let's say, the how stock price or the valuation of business gets impacted by the cost of equity reduction. So if you look at the cost of equity of 15%, if you look at the fair value of the business will stand around 68 rupees. Okay. And let's say if there is nothing, no change happening, everything is status quo, there is no earnings profile change, there is no business prospects change. And even if there is only 1% reduction in the cost of equity, which is linked to the basically the GSEC yield, uh, even in 1% reduction, the valuation will move up by 12%, almost from 68 to 76. Eventually, if there is one more percent reduction, it will go to 86, and it will eventually keep climbing as the rate of like interest rate goes down or the cost of equity goes down. So what my colleague has also highlighted, like RBI has understood the temporary slowdown in the economy, and they have now finally come up and started doing the rate cut. So we are anticipating more rate cuts to follow, which will add or which will act as a tailwind for the companies which have high terminal value, which is typically the case with the growth and high quality company. And we will get the additional boost from the like the valuation expansion, because this is a simple math. Like if the cost of equity goes down, your valuation will go up because of your terminal value going up, or the discounting is happening at a lower rate. So in a nutshell, the time to go into the quality and high growth companies from the next to 4 to 5 year perspective, that is what like we have analyzed, and we have, in our humble opinion, we think it will outperform the value counterpart. Now we will come and discuss like which are the themes, like one should, let's say we have understood like it's a time to get into the quality and growth, but which are the focus areas that one should look and consider or analyze, or where one should allocate the higher capital versus the counterpart versus the underperforming sectors. So in the current budget, like the clear outline for the, let's say, the for the next 4 to 5 year perspective, what government is focusing on the three basic themes, like manufacturing is the continuous theme. So government has already allocated around 1.97 lakh crore to the PLI scheme, which is covered by around 14 sectors. And we have already, the allocation has happened around 1.47 lakh crore. It has created around 12 lakh crore of sales and 9.5 lakh indirect and direct jobs. So government is quite bullish on the manufacturing side. Second is capex. We have seen some slowdown in capex expenditure, but we don't think like the growth rate is not like changing on the drastic factor. The Still the capex has gone up by 10% from 10.1 to almost 11.2 this year as well. So we think like the government is trying to balance out the consumption and the capex part, and it is healthy for the economy to grow in a balanced manner rather than focusing on the creation of capital assets. So that is again a second lever of the second pillar for the bull market. And the third is the consumption. So basically, our GDP per capita was already crossing around $2,600 mark, almost from $2,000 4 year back. So that is quite robust in terms of if you look at the consumption versus the other developing economies. And what we have understood from the past analysis of the developed market, like the consumer discretionary industry will boom at 2x growth rate of consumer staples. And government also had tried to put tailwind by cutting the income tax for the in the under new tax scheme. Also, the multiplier effect which will come from the 1.1 lakh crore will be around 4 lakh crore, which is a 4 times multiplier. And again, if we combine all these factors, so these three factors, in our humble opinion, will outperform into the next 4 to 5 year period. Apart from this, there are three more themes that we have highlighted, like we have envisioned, and we think like they have a disproportionate tailwind. So one theme, like three themes we have already discussed, like manufacturing, consumer discretionary, and capex, which is a capital goods side. But three themes are coming from, let's say, one from financial side, second is from the housing space, which is a building material, and third is the renewable energy theme. So in finance, we typically focus on the wealth management business, because of the lower penetration. So today in India, only 15% of the wealth is managed by the wealth managers. And around 85% is do-it-yourself kind of investing, which typically investors do at their own end. So we think like there is a huge scope if we compare it with the developed economies. So I think next couple of decades we should reach 75 to 80% mark on the wealth management penetration side. So we remain constructive on this space. Second space is like the housing, because GDP per capita is going up. So earning power, or let's say the purchasing power of also the consumers or the retail public is going up. So they will spend disproportionately on the housing side. So we will see secondary level effect on the building material side. Let's say the wires and cables or the pipes or the paints getting disproportionate pushed. And the last is the renewable energy space. So clearly, like Indian government is very robust around like moving the theme, let's say from starting from almost like 500 gigawatt capacity to 1000 gigawatt by 2030. So the government is clear in their mandate, like we need to, let's say we have today 210 gigawatt of renewable energy capacity installed in the India. So they want to take it to 500 gigawatt. So the whole energy mix, if we will look at in 2030, will shift 50% to the old fuels and 50% will be the renewable energy side. So if we look at the next 6 year perspective, starting from 200 gigawatt, we have to add 50 gigawatt every year for the next 6 years almost by 2030, considering 2025 the starting year. So this is the huge push for the renewable energy space. Mainly the solar will get disproportionate benefit because of the high like solar energy that we receive in the India due to the closeness to the equator part. And typically this we are anticipating like that the 72 gigawatt of solar energy capacity will balloon up to almost 200 and north of 200 gigawatt, which will almost go up to around 250 to 60 gigawatt, which is almost 4x if you look at from 70 gigawatt. So this these six themes are we are focusing on from the investment perspective. But also we have also highlighted some risk, like my colleague has already discussed on some part. So I will not spend much time. So basically three risks that we envision is basically the inflation, earnings, and the geopolitical, which are discussed in the previous slide. Now we'll move on to the one case study like that we highlighted in the past webinar. So we thought like we will use one example to understand or to explain the correction in the market. So typically when there is a market correction, or let's say there is a correction in the stock price, so we have to understand like the correction is either due to the business correction or the business value correction, or there is a correction due to the market sell-off. So to understand it, we have to dig deeper. We have to understand how the earnings are growing, whether earnings has gone up or earnings has gone down. So to for that matter, we have taken this example of Sky Gold. So basically, Sky Gold is a contract manufacturing company for the in the jewelry space. So it manufactures gold jewelry, and for the for the Tanishq or the, let's say, the Joy Lucas, Malabars, and the PNG and Senko Gold, and it sells it at the 4 to 5% kind of operating profit margin, because it's a basically contract manufacturing space. So you play on the volume, not on the absolute margin. But your asset turns will be very higher. So you will end up generating ROCE north of 25-30%, basically multiplying the lower margin with the higher asset turn. So you will end up generating that 25% kind of ROCE. And the company is targeting to grow its earnings to around 7,200 crore. They have already done capacity expansion of around 4x in the last quarter. And in this quarter, if we look at, so around last quarter, the stock price was around 488 rupees. We entered it around 112 rupees before the split. So these are the adjusted price for the bonus that company has given. So we entered around 112, it went up to 488. We made around 4.3x. But what we have seen, like the stock has also gone under severe correction, and it has down 24% from the top, which we have captured in the table. So, so we have to understand whether this fall is because of the contraction is the business value, or is it because of the market sell-off. So, in the recent quarter when they posted the result, so their earnings, or the if you look at the operating or like the profit growth, it has almost become 4x. So it has gone up almost like more than 300%. And if we look at the last 9 months, it has gone up around 251%. So, and companies also anticipating very solid demand from the new clients. They almost went up to the 450 kg per month of capacity. So they are already at 45% capacity utilization. and they think in the 2 years they will be able to utilize the whole capacity and they will plan for the future expansion. So clearly the business has grown up, the profit has gone up, but the stock price has corrected. And if you look at the valuation, so 1 year forward is trading at 35 XP, given the high growth profile of around 30% over the next 3 to 4 years. So we think that this correction provides very high margin of safety, or let's say the margin of safety has gone up because of the price correction. If it would have been the case, let's say there is earnings are going down and stock price is going down, then in that case, like the correction is actually the fundamental. It is not because of the market sell-off. And in that case, typically we will also exit the stock because business fundamental has deteriorated. But in this case, what we have seen, like earnings has gone up, but stock price has still corrected. So it is signal that market is trying to misprice the opportunity which is present in the this particular business, and we can take this opportunity and put more money or even do top up in such kind of businesses depending on the scenario or the outlook of this business. But the key point that keep into the mind is like whenever there is market sell off, so we should be very clear either it is happening because of the fundamentals or it is happening just because of the broad market sell off. So in our universe that we track at Right Horizon, till now, what we have seen, like around 3 to 4 companies have given results which are below expectation, but other 25 of the companies, whether 75 to 80% of the companies have given results which are above our expectation or meeting the expectation. So in a nutshell, we don't see the earnings being the problematic for the our universe, although we have also taken the correction in this portfolio in this recent fall, but we don't see it as a structural. We see it as a temporary phase. It may happen like this correction can last up to, let's say, 2 to 3 quarters because of the sentiment turnaround and the cuts which have happened from the government side in the tech side, or let's say even the liquidity boost which is coming from the rate cut. And government has also, like RBI has done the open market operations around 40,000 crore. Earlier it was planning to do 20,000 crore, but they have pushed it to 40,000 odd crore in the open market operation. So all these things will provide a huge boost to the economy, but it may take time, let's say 1 quarter, 2 quarter, or 3 quarter delay. And we think that this is a good time, whoever wants to top up the money in the quality and the high growth companies. Of course, it will be a bumpy ride, it will be volatile times for the next 2 3 quarters. But if one can stagger the amount in this space in high quality and high growth companies, because of the lower valuation, one can get disproportionate benefit. And the fruits will be visible, of course, after the 2 to 3 years of period, like as we have highlighted in the past as well. Like always, after this 20% kind of correction, the typical stock like the index which goes up is around 200 odd percent in the next 3 to 4 years. So I think this is a similar opportunity which was presented in March 23. Similar to that, it has come to us in February 2025. So with this, we conclude this session.